for the progress test, I will return the scripts back to you by Tuesday or Wednesday next week. All right. So because at the moment, I'm busy marking the undergraduates final exam scripts. So I think by maybe Monday I should finish, and Tuesday I can actually mark the progress test. All right. So once I finish marking, I will return to you by way of email, the same email that you sent to me. And then the other thing I was saying is that some of you probably overspend the time, so which means that you still have to work on your time management so that you can actually, in the final examination, you can actually attempt all questions. All right, so it is very important for you to attempt all questions, yeah? Okay. Can we just start today? Because today what we are going to look at is financial instruments. All right, so I will just share the screen. Hold on a second. Share the screen. Okay, so for financial instruments, most of the students, I mean in your undergraduate studies as well, you will find that financial instrument is some standard that is quite abstract. I mean, you can learn the theory, but then the practical part of it doesn't seem like, easy. But nevertheless, from the past year questions, usually they do not test you very detailed with respect to financial instrument. All right. Unless in the earlier years whereby the financial instrument standards were still in the procession of being superseded and then replaced. And at that point in time, it was a current issue. So right now, the financial instrument standards have already stabilized. So you can see over here that we have IAS 32, right? We have IAS 32. Then we have IFRS 9. IFRS 9 was previously IAS 39. And this IAS 39, when they supersede it to become IFRS 9, it actually took a very long time. So why? Because they were superseding the standards paragraph by paragraph. Okay, so the project took about 4 years or so before they finally come up with IFRS 9. Another standard with respect to financial instrument is your IFRS 7. IFRS 7 is with respect to disclosure requirements. Okay, so basically IAS 32, IFRS 9, IFRS 7. Those are the three standards with respect to the financial instruments. So of course, on IAS 32, you will be looking at classification. So basically, in terms of financial instrument, you will have financial asset, FA. Then you have financial liability. And then the next one, you have equity instrument. So later, we are going to look at what are the definitions of all these classification of FI, financial instruments. So of course, the first thing we need to realize is what's the definitions of that makes up financial asset. What are the definition with respect to financial liability and the equity instrument? Okay, so recognition in the books, which means that if you know that you have certain financial asset because it fulfills the definition, financial liabilities because it fulfills the definition, how are we going to recognize them in the books? Okay, and if we were to recognize them in the books, should there be any transaction costs? So how do we deal with the transaction costs? Okay, derecognition is something that we have looked at, especially when we look at the conceptual framework, which says that, there are principles with respect to derecognition. So derecognition basically just means at which point in time should you remove the financial instrument from the books. Okay, and of course, we will also look very quickly with respect to compound instrument, or some books will tell you it's called hybrid instrument. Why? Because that particular instrument comprises of financial liability component as well as the equity components. Okay, so which means that, how do we know we have a compound instrument? So which means that somewhere in a scenario given to you, they will probably tell you this particular loan stock or this particular debentures has a convertible feature. So if it has a convertible feature, which means that it is a compound instrument. Okay, at some point in time, you can actually convert it into ordinary shares. So how do we deal with compound instrument? And of course, the measurements with respect to IFRS 9 in our books. The second part of the financial instruments, basically, we will be looking at derivative instruments. And then we will look at ECL, and then we will look at some cash flow hedging. Okay, so let me just move on to the next slide. So basically, like I mentioned, classification and all those. So basically somewhere from here to here. The earlier portion, the top portion is basically our part one of the notes. So which means that we will be looking at IS 32 with respect to the classification, recognition, derecognition, measurement. Okay, so when we talk about measurements with respect to financial instrument, later we will know that IFRS 13 plays a very important role because it's either the financial instruments are measured at amortized cost or they are measured at fair value. Okay, so you may have fair value through the profit or loss, fair value through the OCI. But when we talk about fair value, then we will talk actually with respect to IFRS 13. And I think that IFRS 13 has already been covered by Miss Lim, right? Okay. Then the second part of the notes will talk about hedging, impairment, and embedded derivatives. However, embedded derivative, we are just going to remove it because with respect to the ACCA syllabus, they have removed the embedded derivative from their syllabus. So which means that the second part of the notes, we will only be dealing with hedging. What does it mean by to account for the transaction as part of the hedging accounting? And how do we actually provide impairment for our financial assets? So under the impairment, we are going to look at ECL. ECL means what? Expected credit losses. Okay, under the ECL for the impairment, you will have stage 1, stage 2, stage 3 ECL. All right, so this one is some so-called approach that the standard setter says that it is forward-looking because they talk about expected. Expected means what? Before impairment took place, you already accounted for them in the books. So which means that you are very forward-looking. Previously, it is called the incurred losses. So, I mean, when they were just updating the standard at time, they were saying that, oh, incurred losses is no good. Why? Because they tell you it is looking at the past. Only when the losses or the impairment took place already, only then you will book them in the books. They say, no, this is not good enough. Okay, so right now we are supposed to be following the expected credit losses model. So this expected credit losses model, we have certain illustrations that we are going to look through later on, probably in the afternoon, I guess. All right, so we are going to look at the upper portion first when we look at this set of notes. Okay. All right. So the question is, when I was a student that time, we don't have this particular financial instrument standards. All right, we don't have, because at that point in time, there were no such business transactions. Okay, but at the current business landscape, you find that, you know, there are many international financial markets, and then there are ways, many ways for the businesses to enter into transactions. And because there were no standard to capture them on the balance sheet, then they were just entered into, but not reflected on the balance sheet. Okay, but not reflected on the balance sheet does not mean that you are not um, subjected to the risk. All right, the risk is still there. It's just that, you know, from the users of financial statements point of view, they are not aware because they can't see them anywhere in the financial statements. Okay, so that is why with this particular standard, they tell you that, oh, actually, you need to reflect them in the books. Okay, so that the users are aware, oh, I have this kind of risk, I have that kind of risk, and then this is something that I have entered into. Okay, so that's why they tell you this standard came about because of the dynamic nature of the international financial market, where many financial instruments were off balance sheet. All right. So you also will see later on when you look at IFRS 16. IFRS 16 was also a standard that has gone through certain updates, especially with respect to the accounting for lessee. Okay. Previously, under the accounting for lessee, they tell you that, you know, oh, you have to split between operating lease and the finance lease. But with IFRS 16, they tell you no. Now we have only we don't split, we don't distinguish, but there is only one way to account for the leases in the books of the lessee. That is to capture the ROU asset and book in the corresponding lease liability. So that means right now, with the new standard of IFRS 16, all leases will be captured in the books of the lessee. All right, irrespective, not like last time, okay. So same things with the financial instrument. They're telling you that, oh, okay, now because the business transactions, especially the financial sectors, have become so complicated. All right, we actually need a standard to capture all these so that the users of financial statements are well informed. Okay, so accounting for financial instruments come into the picture. So you will find that the first standard that we will be looking at is the IAS 32. So this one will be the first standard, IFRS 9 will be the second, and the third one is the IFRS 7. IFRS 7 is with respect to disclosures. Okay. For IAS 32, basically it is just the classification, right? How do we know we have financial instrument? And if we do have financial instrument, are they part of financial asset, financial liabilities, or equity instrument? Okay, so when you look at financial asset, financial liability, equity instrument, the first thing that comes to your mind will probably be what? Oh, your assets, your liabilities, your equities in the SOFP. But then later on, when we look at the definitions of financial asset, financial liabilities, you will realize that not all assets are financial asset. Not all liabilities are financial liabilities, because for it to be recognized as financial assets or financial liabilities, they need to fulfill the definition. Okay. And just now I have mentioned that you may have compound instrument. Compound instruments are the instruments that are convertible, which has financial liability components plus with the equity components. Okay, so you will have both financial liability components and the equity instrument components. And for this particular compound instrument, later we will look at split accounting. Okay, how do we split the liability component separate from the equity components? Okay, so this is with respect to IAS 32. IFRS 9 will talk about the recognition. So like I mentioned, the recognition in the books could be at amortized cost, at fair value, and then how do we distinguish? How do we know this particular financial assets must be recognized based on the amortized cost? Okay, so what are the characteristics that you need to fulfill in order to recognize it at amortized cost, at fair value through the OCI, at fair value through the profit or loss? And then we will look at hedge accounting. We will look at one illustration called 1A, which is with respect to cash flow hedging. Okay, towards the tail end of the class today, yeah. And then, of course, IFRS 7 is with respect to disclosure requirements. This is the slide with respect to the definitions of financial assets, financial liabilities, and the equity instrument. So like I say, this looks like assets in our normal SOFP. All right, this looks like our liability, and this is our equity. Okay, so when you look at assets, liabilities, equity, does it remind you of your basic accounting equation? I'm sure it does, isn't it? So what was the basic accounting equation? Assets equals to liabilities plus with the owner's equity. All right. So when we have this particular equation, it's like, day one, when you just embark into the financial accounting, you are always exposed to the basic accounting equation. So the basic accounting equation says what? Assets equals to liabilities plus with the owner's equity. Okay. And of course, this particular equation, you can rewrite again. So when you take the assets minus the liability, maybe I should thickness, let me just put it, otherwise can't see, okay, let me see, does it make a difference? Oh, okay, too thick. Okay, so if you take assets minus the liabilities, you are going to get the equity. So in other words, what we are saying, equity is always the residual, the balancing. Okay, maybe I write here. Assets, if you so-called rearrange the equation over here, which is assets equals to liabilities plus with the owner's equity. All right, if you rewrite it, it will be what? Assets minus liability equals to equity. Okay, so in other words, assets, after you remove all the liabilities, you have the equity components. In other words, the equity components are always the residual, the remainder. Okay, so which means that for this particular equity instrument, in terms of IAS 32, the equity instrument is also the residual. All right, just the residual interest, because whatever left behind belongs to you. All right, and this particular equity instrument definition over here says what? Any contract that evidences a residual interest in the net asset. Net asset means what? Assets minus the liabilities. So you will find that, as per the basic accounting equation, and as what you can see in the financial instrument standards here, we know that equity instrument is always the residual. Okay, and this one will give you what is the definition of the financial instrument. So they tell you any contract that gives rise to both a financial asset on one entity and a financial liability or equity instrument of another entity. Okay, and this particular type of contract is a contractual contract. Okay, so this contract is a contractual contract. Okay, this is a contractual contract because some of those contracts that you entered into could be what we call not only a contractual, but it could be a legal contract. Okay, maybe like the law requires you to do something, and then that one is not the same as a contractual contract over here. Okay, so any contract that gives rise to both a financial asset as well as a financial liability on the other side. Okay, so this is the definition of the financial liabilities. So over here, they tell you definition of financial assets. You have cash. Cash is always a financial asset. And of course, we know that cash is also part of our current asset. And then equity instrument of another entity. What's the example of equity instruments of another entity? For example, you may have investment in subsidiary, let's say. Investment in subsidiary is part of the financial asset. Let's say in the books of the holdings, you will find investment in company XYZ. And so happen company XYZ is a subsidiary status. So which means that investment in subsidiary is part of the financial asset. Okay. And the part C here gives you the general definition of what constitute financial asset. So they tell you for financial asset to be classified in the books under the IS 32, it must have a contractual right to receive cash or another financial asset, and this particular exchange will be conducted under conditions that are potentially favorable. Okay, so in other words, when you enter into certain contract, like for example, if you have a trade receivable, so which means that, you sell goods to your customers, you let them owe you first. So you created a trade receivable. So this particular trade receivable is part of a financial asset because it gives you a contractual right to receive cash. And when you exchange this particular cash, you are better off. So which means that they are exchanged under conditions that are potentially favorable to you. Okay, so this will be your financial assets definition. So if you contrast it to the financial liabilities, of course, we know assets and liabilities, they are two extreme ends, so the opposites. So since the assets says, in terms of assets, we are saying that this gives you a contractual right to receive cash. All right, contractual right to receive cash. So in other words, over here, you have a contractual obligation to deliver cash. Right? So you have to have certain outflows. And of course, once you have this particular certain outflows, you have an obligation to settle this outflow, meaning that they are exchanged under conditions that are potentially unfavorable to you. Okay? Because money will leave your bank account anyway. Right now. So this is an obligation to deliver cash. This is a right to receive cash. Okay, so of course, these two, you can see the difference. And then as mentioned, equity instrument is always the residual. Okay, so the next slide, we can see what are the examples, examples of financial asset, financial liabilities. Okay, so you can see over here, of course, this is still the definition, examples of financial asset. Have a quick look at this, as well as the financial liabilities, and then this is your compound instrument. Just think about where you have seen such items when you so-called prepare your financial statements. Give it 2 minutes to have a look. So if you look at the financial asset, you will find that the first item of the example here is CACE. Where do you see CACE before? CACE is your cash and cash equivalents. So which means that when you prepare your cash flow, your consolidated cash flow statements, you will see this particular item. So remember just now we say one of the definitions of financial assets will be cash. So CACE is almost like cash. Cash, we know, correct, is part of financial asset. Cash equivalents means what? Cash equivalents means those that are easily converted into cash within a short period of time. So let's say if you have investments in shares that are listed in the open market, let's say listed in the Bursa. So which means that whenever you need money, you can just very quickly dispose of the shares that you are holding for cash. Of course, that is based on the assumptions that you are not bothered whether you make profit or loss. Okay, so that is your cash and cash equivalents. Then you have investment in shares in another entity. Like what I mentioned just now, you may have investment in subsidiary, investment in associate. Okay, so whatever all these, they are part of your financial assets. Receivables, you may have trade receivables, you may have other receivables. All this gives you a contractual right to receive cash. Next one is the investments in bonds. So sometimes you have to be a little bit careful because sometimes once you look at the word bonds, the first thing that highlight to you is that, oh, bonds is part of liability. But remember, this is an investment in bonds. So which means that you must have used your money to invest in the bonds that is issued by another entity. Okay, so which means that what? Putting in money, and then at some point in the future, when the investment in the bonds matures, I'm going to get back some returns. Okay, so this is part of my financial asset. Okay, because it didn't say just bonds. If it just say bonds alone or loan stock alone, then it will be part of financial liabilities. But this one is an investment in the bonds. Okay, so because it is very important for you to be able to distinguish whether a particular instrument falls under financial asset, financial liability, or equity instruments, because later the accounting treatment will go by the classifications of of whether it is a FA, FL, or equity instrument. Then you have the financial liabilities. Examples of financial liabilities will be all these: trade payables, loan from other entities, okay, debentures, loans, RPS. You know what is RPS, right? RPS is a redeemable preference shares. So redeemable preference shares, as we know, it is classified under NCL. Okay, NCL, non-current liabilities. So which means that it is part of your liabilities as well. So of course, equity instrument usually will be the ordinary shares that you have issued out. Ordinary shares. So sometimes, as I mentioned, certain instruments that has been issued, they actually contain certain elements of liability as well as equity. So which means that it has a mixture of both. How do we know it has a mixture of both? Because initially it is a liability, but then at some point in the future, they tell you they can be converted into ordinary shares. So the keyword to distinguish that you have a compound instrument will be the word convertible. Convertible. Okay, so if you have a convertible loan stock, convertible debentures, usually they are compound instruments. So compound instruments means what? They comprises of the elements of liability plus the elements of equity. So how do we split between the liability component and the equity component, we are going to perform split accounting. Split accounting. So this one, I believe that in your undergraduate studies, you have done this, okay? But it is something that probably they will incorporate as part of the adjustments, but there will not be a standalone question on this, okay? Okay, then coming back to here, you see assets and liabilities, of course, we can quite easily distinguish the difference between the two because they are two opposite ends, right or not? But with respect to liabilities and equity, as you can see the basic accounting equation, assets equals to liabilities plus with the owner's equity. So these two are at the same end. That means assets, liabilities, opposites. But then these two are at the same side of the equation. So which means that sometimes there are certain difficulties to distinguish between the liabilities and the equities. Okay, so that's why there is one particular article that talks about whether the financial instrument is equity or liability. So they say that, since they are both like same, but actually they are not the same, all right? So they tell you that it is important for you to know what are the characteristics of the equity instrument, what are the characteristics of the liability component. All right. So this one basically is there is a, what do you call that? An article, So this article has been there for some time already, but the important thing that I want to tell you is that, it was in CPD, a technical article in 2013. So which means that you have your ACCA global website. And this ACCA global website, as a student, you can also so-called access to those documents. It's probably all there, very simple for you to navigate. And then you have the education hub. All right. So for purposes of the examination, I think that it will be good for you to visit the education hub as well, because sometimes they will have announcements, they will have new articles, they probably will have some debriefing of the past year questions there. Okay. So it's probably good for you to go and revisit. So over here, important one that I want to highlight is Graham Holt. Okay, Graham Holt is actually the chief examiner of your SBR. So, of course, chief examiner means that they have few people, few examiners to help in coming out with the questions because I think it is quite a so-called not an easy task because 1 year you have to come up with 4 sets of questions because there are 4 sittings. Last time there's only 2 sittings. Okay, so Graham Holt is a very old gentleman, but very experienced, and he has a team of the examiners. So far, the last I checked, he is still the so-called chief for the SBR. So this is the article that has been written by him. So which means that if you have come across any of those more recent articles that are written by Graham Holt, you probably have to pay more attention to it. Okay, so usually that is the so-called very subtle kind of hint what may be appearing in the next examination. Okay, so later you can have a look at this. So basically they tell you how to distinguish between the equities, liabilities, all right, and then with respect to the debt instruments, with respect to the financial instrument under the IS 32. Okay, so the link is already in your notes, so later you can just have a look. Oops. Okay, so these are the defining moments. All right, so they tell you what is it that they need you to distinguish. What are the characteristics? Liability, equity, how do you know? Okay, so the key takeaway point from this article, they tell you a financial instrument is an equity instrument. So of course, they tell you what is the equity component part. Equity instrument only if the instrument contains no contractual obligation to deliver cash or another financial asset, and if the instrument will or may be settled at the issuer's own equity instrument. So which means up to here is basically let's say if you talk about it comprises a contractual obligation to deliver cash or another financial asset, that will be the definition of financial liabilities. But if they tell you, oh, there is no such things, so which means that it will fall under the definition of an equity instrument. And the other part is if the instrument will or may be settled at the issuer's own equity instrument. That means you either issue your own ordinary shares to settle, or what do you call that? Will or may be settled using your own equity shares, ordinary shares. Okay, so sometimes it is a bit difficult to explain about the equity instrument. So they tell you if it is not fulfilling the definition of the financial liabilities, then it must be an equity instrument. And if you find that the scenario tells you that the instrument will or may be settled by the issuer's own ordinary shares, that means that is part of your equity instrument. So since we have seen the definition of financial instrument, what constitute financial liabilities, the definition including the examples, same goes with the financial liability as well as the equity instrument. So now we would just want to have a look at this particular slide, which says that not all assets are financial assets. Okay, we cannot say for sure. Not all assets are financial assets. Some assets are financial assets, some assets are not. So similarly for liabilities, not all liabilities as captured in the SOFP are financial liabilities. Not all, only some of it. Okay, so you can have a look at this particular table below here. Prepaid expenses is something that we will see quite often in our SOFP. We will also see quite often tangible asset, let's say your PPE. Okay, maybe easier for me to explain by PPE. So tangible assets. So tangible assets like your building and stuff. Okay, does the building and your equipment and all those tangible assets gives you any contractual right to receive cash or not? No, right? Because any contractual right to receive cash basically is the definition of the financial assets. Does it give you any contractual right to receive cash or another financial asset? Of course, this will be conducted under conditions that are potentially favorable. So we will find that if you have a PPE, it doesn't give you any right to receive cash. There is no contractual right to receive cash. Rather, you have control over the PPE, and that particular control will help you generate cash inflows. If let's say, for example, the price of the building has gone up, then it gives you more money, all right, because the price of the building has appreciated. But it does not give you any contractual right to receive cash. So in other words, PPE, any of your tangible assets, they are not part of financial asset. So if you look at this prepaid expense, so we may say prepaid insurance, let's say, prepaid insurance. So if you have prepaid insurance in your books, it is, what is the meaning of prepaid insurance? So it just says that For the insurance coverage, you have already paid ahead in time. So as time passes by, you're supposed to have a right to get your insurance coverage, but it does not give you any right to receive cash. Understand what I mean now? So they will just tell you, oh, since you already prepaid the insurance premium or you prepaid your electricity bills, so in the future, as time passes by, we will just provide you with the insurance coverage. We will just provide you with the electricity services, but we will not have any contractual right to receive cash. Okay, so it's either to receive the goods or the services, but not the right to receive cash. So, in other words, prepaid expenses, prepaid insurance, and all do not fulfill the definition of financial asset. So they are not financial asset. Then we look at financial liabilities. Deferred revenue. Deferred revenue means what? Some revenue that you are going to receive. No, no, not some revenue. Deferred revenue, like for example, we say uh, uh, think deferred revenue. So that means some revenue that you have not provided the services for. So someone pay you ahead, and then you say that, oh, today I cannot provide you the services. So of course you debit your cash, but you can't credit your revenue. So this is part of your unearned revenue. So in the future, you're supposed to have the obligation to provide the services or to provide the goods, but there is no obligation to pay cash. Understand? So in that particular analysis, we are saying that since there is no obligation to deliver cash to the other party, then it does not fulfill the definition of financial liabilities. So deferred revenue is also not financial liabilities. Income taxes payable. This is quite common in our SOFP. Usually we will have current liabilities, taxes payable. And taxes payable, even though you have an obligation to deliver cash, but this obligation is not a contractual obligation, but this is a statutory obligation, which means that the income tax, uh, what do you call that, act, or the law requires you to pay taxes. So this is not a contractual, but this is a statutory. So since this is a statutory obligation to deliver cash, you also do not fulfill the definition as a financial liability. Okay, so this will tell you what's the difference between financial asset with the assets that you see in your books, and between financial liabilities and the liabilities as captured in the SOFP. So since we are still at the how to distinguish between financial liabilities and an equity instrument, you just have a quick look at this particular summary. Okay, so for you to appreciate this, it will be easier if you can probably say characteristics of financial liability, you think about debentures. Characteristics of equity instrument, you think about your ordinary shares. Okay, just take a few minutes to have a look at this, and then it's not something that is new, but it's something that you have already done many, many times before. Okay, then shortly, we will just run through. So far, any questions or not? Where's this thing? Any questions? No, okay. Just have a quick look at this. Financial liability versus equity instrument. So of course, when we want to distinguish between the two, we have to discuss on their characteristics. So think about your debentures. So let's say you have 8% debentures. What does the 8% mean? 8% is a fixed interest payment. Okay, so it's a fixed interest payment. Whether or not the company is making profits or not, they tell you, oh, I don't care, because my debenture carries 8% interest. I must be paid 8% interest yearly until the maturity. And of course, this particular debentures will have a maturity period. Maybe it matures 10 years from now, so it has a fixed period. And let's say, for example, the company that issues out this particular debenture faces bankruptcy. So business is no good. They want to close down because someone sued them for bankruptcy. So they need to repay back all these so-called suppliers of finance. So when we have debentures, we probably have ordinary shares. Who do you think will be paid first? Of course, the debentures will have priority of claim. Then, if you have preference shares first before your ordinary shares. So for the debenture holders, they have priority of claims. And of course, we know that only ordinary shares have voting rights, which means that debentures do not have any voting rights. Okay, so we go back to the ordinary shares characteristics. So of course, we know that ordinary share cap holders, ordinary shareholders will have voting rights. So this will also be the case when we want to see whether do we have any parent subsidiary relationship or not. Of course, we only look at the ordinary shares that was acquired by the other entity. Correct or not? We don't look at debentures. We don't look at preference shares because those do not have any voting rights. When the company is being liquidated, you will find that ordinary shareholders will be the last to have any claims. And because this is an equity, you will find that they only are entitled to the residual. Sometimes not enough, then the ordinary shareholders gets nothing. Okay, no fixed term, forever and ever and ever. The ordinary shares capital that you have invested will still be there in the company for a long, long time to come, until and unless the company closes down. You see whether there is any balance or not. No balance, nothing you can take home. If there is some balance, probably a little bit, you can recover from your principal. No fixed payment, especially with respect to dividends. So the dividends with respect to the ordinary shares will fluctuate in accordance with the company's performance. Okay, so you can contrast these characteristics between the financial liabilities and the financial and the equity instrument. And of course, in terms of the accounting treatment, equity instrument shown as part of equity in the SOFP. And should there be any dividends that is being paid, this will be shown as part of the appropriations of the retained earnings. So which means they will be captured in the SOCIE. However, if you have a debenture, and as we know, we have debenture interest that we need to pay. So debenture interest will be captured as part of the finance cost in the SOPL. And in the SOFP, this is captured as part of the liabilities. So of course, if the repayment is more than the next 12 months, then you will put it under NCL. However, if the maturity is within the next 12 months, you will still put it as part of the current liabilities in the books. Okay, so what is the impact of the financial liabilities on the gearing and on the profit? Gearing means how exposed is the entity to external financing. So if you have issued debentures, that means you are exposing your companies to external financing. That means you take money from outside of the entity to finance your business operation. Of course, the gearing will be affected, the gearing will increase. And then since the dividends, not dividends, sorry, since the interest is captured as part of the finance cost in the SOPL. So, which means finance cost increases, the profit reduces. Finance cost will increase. Okay, of course, expenses goes up, profit will reduce. However, in terms of the equity instrument, you will find that, oh, because this is internal financing, gearing will be either not affected or compared to the issuance of debentures, the gearing here will decrease and profit is not affected. Why not affected? Because the dividends is shown at the level of SOCIE, which means at the bottom. Okay, profit is on top. After you get the profit, then only you issue out a certain portion of it as dividends. So, which means the profit after tax of the entity will be unaffected. Okay, so this one is just in brief. What are the characteristics that can distinguish between financial liabilities and the equity instrument? So we can look at the recognition of the financial instrument in our books. So the thing about financial instrument is that usually it is very easy to enter into, or it is very easy for you to engage in some issuance of some financial instrument. But then the thing here is that because of the how do we put it? Because when you want to engage in this kind of financial instrument, let's say, for example, forward contracts and so on, the cost to enter or to engage in this kind of instruments is very low or zero at the inception. So which means that, you just sign a piece of paper and then you say, oh, okay, I have already got a financial instrument for purposes of this particular purchase, let's say. All right. So very simple. You don't have to come out with any initial cash outflow. It's just like people tell you, oh, now you can own a house, but no need to put down payment. Okay, so in the earlier years, when you want to buy a house, also it's very difficult, right? Because down payment is a hassle. You don't have the money. Once you got the money already collected, save up, then you want to buy the house, the price of the house has gone up. So it's very difficult for you to enter into such transaction. But for financial instruments transactions, you find that it's very easy. Why? Just sign the agreement, no need to pay out anything normally lah. Or if you need to pay, also is very low at the inception. Okay, so they tell you, with respect to IFRS 9, as I mentioned, it takes many years for the IFRS 9 to be finalized. So they tell you, first published 2014, effective 2018. Even though when it was first published that time, it also takes many years of refining until the standard is made effective. So of course, during that time of refining, you will find that you don't want to be engaged in taking this particular ACCA professional examination because there were so many classifications. If I'm not mistaken, 5 or 6 classifications. So it's very messy. Okay, but right now they already finalized already. You only have 3 different classifications. So it is life made easier for you. So with respect to financial assets and financial liabilities, at which point in time should you recognize them in the SOFP? Because remember, one of the objective of the financial instrument standard is to make or to ensure that all the transactions gets reflected in the books. Okay, so when you want to record the financial liabilities, when you want to record the financial assets in the SOFP, it is when the entity becomes a party to the contractual provisions of the instrument. So which means what? Today, when you sign the agreement to enter into, let's say, for example, over here, to enter into a forward contract. So which means that you are already a party to the contractual provisions of the forward contract. So in other words, when you prepare your financial statements, you have to record already. Okay, so forward contract, which is one of the example of a derivative instrument, will be recognized in the financial statement at the inception. Inception means what? At the beginning itself. Even though no need to come up with any money. Okay, so how do we record? Because there is no money, there is no money, no outflow, so we can't credit the bank and so on. Right? But we still have to put down as part of the disclosures in the books. Okay, so forward contract is what? An agreement to buy or sell an asset at a fixed price at a fixed future date. So later we will look at forward contracts, we will look at futures contracts. Okay, so which means that when we want to recognize the financial instruments in the books is when the entity becomes a party to the contractual provisions of the instrument. And then sometimes we have to distinguish between those contracts that are entered into because of the ordinary activities of the business. Okay, contracts that are entered into because of the ordinary activities of the business are what we call executory contracts. Okay, so executory contracts are normal purchase transactions in the ordinary course of the business. So let's say if I buy certain raw materials, and this particular raw materials, I use it in my production process in order to come up with finished goods. So this kind of transactions is not, what do you call that, a financial instrument kind of transaction, but they are executory contracts because every day I will buy already that I will use in my construction, in my manufacturing process to come up with the finished goods. So this is within my ordinary course of the business. And because of that, they are outside the scope of IFRS 9, outside. So they tell you, contracts that are entered into for the entity's expected purchase, sale, or usage requirements are non-financial items are outside. So these are executory contracts. Okay, so over here we have this more elaborated definitions of what constitute executory contracts. Contracts under which neither party has performed any of its obligations, or both parties have partially performed their obligations to an equal extent. Example, an unfulfilled order for the purchase of goods, where at the end of the reporting period, the goods have neither been delivered nor paid. So which means executory contracts are what kind of contracts? Maybe what you can visualize is what? You just call up the supplier and then you tell the supplier, I want to make an order for delivery of 300 tons of this raw material A. So it is just a contract that you have entered into for the raw materials. But after this call has been made, there were no further actions taken by either of the party. So which means that they just jot into the books, oh, so and so company call up and then they want to order this. But the entity that makes the order did not pay. Then the seller or the supplier did not deliver any of the goods. So in other words, neither of those parties have done anything so far. So these are executory contracts. Okay, so example, A forward contract to purchase cocoa beans for the use in making chocolate is not accounted for until the cocoa beans are actually delivered. Okay, because this is part of the executory contracts. If it is part of the financial instrument boundary, then you will have to reflect them in the books when they become a party to the contractual provisions of the instrument. Okay, got that? So this one, we will only, it's just like our executory contract. You go and order the cocoa beans for your chocolate manufacturing process. Once you make an order, there is nothing for you to record in the books. Why? Because the goods has not been delivered, ma. So once the goods has been delivered, then only you enter the necessary records into your books. Correct now? Then we can look at derecognition. So derecognition means what? When you want to remove them from the books, or you record because it fulfills the definition. And when do you record? When the entity becomes a contractual party, when it becomes a party to the contractual obligations. Okay, so now when you want to derecognize, derecognition will take place when the financial asset has expired. Okay, maybe the right to receive cash already expired because the customer has already paid whatever amounts that they due to you, or the financial asset has been transferred. So in other words, it has been sold to another party. So which means that if the asset has been sold, it has been transferred, that means all the risks and rewards with respect to this particular asset has already gone to the third party, which is the buyer. So once all the risks and rewards has already been transferred to another party, then you can derecognize the financial asset from your books. What about the financial liabilities? When are they derecognized? When they are discharged. So you pay off your loan already, your loan will be discharged, ma? When they are cancelled or when they expire. Okay, so sometimes if a certain part of the liability has been discharged, so only that portion will be derecognized. You can't derecognize the whole portion. You have to derecognize part by part. Okay. So now this is a simple illustration to see whether the financial instrument should be derecognized or not. Okay. And of course, here we will have this definition of call option. Call option means what? It is some rights, but not an obligation for the holder to exercise at a predetermined price. So we look at the scenarios given to you. We have scenario A, scenario B. So discuss whether the following financial instrument will be derecognized. So when do you derecognize them? When you find that they have been what? Expired, transferred, discharged, cancelled. Okay, these are the conditions for derecognition. AB company sells an investment in shares. So that means they sell already some shares to another party, but then they retain a call option to repurchase those shares at any time at a price equal to their current market value at the date of repurchase. So which means what? They tell you, hey, actually I sell you the shares already, but at any point I want those shares, I can buy back because I have this call option. But then remember that the call option is just a right. That means you have a right, but don't want to buy back also can. That means you don't have an obligation. But if you have an obligation to buy back, it's different, which means that no matter how, you must buy back. There is no choice given to you. But since this is just a call option is just a right. A right means that you want to, you buy back. You don't want to, no need to buy back. So, which means that at this point in time, AB company should be able to de-recognize because the call option, that means the option to the right to buy back is just a choice. Okay, so AB should de-recognize the asset as it is only an option to purchase at the prevailing market value. So they just tell you that, you want to buy back, you can. You don't want to buy back, it doesn't matter because it is just a right, not an obligation to buy back. Let me look at the next illustration. Discuss whether the following financial instrument will be de-recognized. So you have this. EF company enters into a stock lending agreement. This stock is not your inventory. This is a shares. Maybe you have shares of your company, but then what you do is that you take your shares and loan it to another party so that they probably, can get some financing or a loan, something like that. But you just pinjam only. Later, you are going to take back one. Okay, but of course, when you pinjam the third party, it doesn't mean that you pinjam them just for fun. You're going to charge them. Okay, it's just like temporarily I let you use this as part of your assets, but then later I will take back. And during the interim, when you take this as when you are borrowing this from me, you have to pay me some amounts. Okay, so EF enters into a shares lending agreement where an investment is lent to a third party for a fixed period of time for a fee. So this is quite normal lah. Okay, so can EF company de-recognize the asset or not? Because eventually, after the fixed period of time is over, the assets will be returned back to EF. And during the so-called loan period, of course, the assets are temporarily given to the third party. But EF actually retain substantially all the risks and rewards of this particular asset. That means, let's say once the shares have been returned back or during the interim, when the shares were loaned to a third party, the price of the shares went up. Who is going to reap the benefits? Of course, EF lah, not the third party. So under such cases, the risks and rewards are still retained by EF, and therefore the EF cannot de-recognize these assets from the books. Okay, so the stock should be retained in the books even though legal title has temporarily transferred. Okay, like that. So now we look at compound instrument. Okay, compound instrument. So compound instrument, as I mentioned this morning, it is some instrument that contains the convertible feature. And this convertible feature means that they will have elements of financial liabilities plus with elements of equity. Elements of financial liabilities and elements of equity. Okay, and usually the method to do the split accounting is to determine the liability component first. Then equity, remember equity is always the residual. So equity component will be the residual. Okay? And let me just have a look. This one we don't need. Did I give you this? I did, right? Oh, this EF, later I will just screenshot for you. Compound instrument. Okay, now for the moment, while I take down the screenshot to fill in the blanks, you just have a look at your CRICOS. CRICOS SA. Okay, just give you the answers to the earlier part. just have a look at the compound instrument illustration first. Okay, on the D recognition portion, yeah. And then this one, I think you can just fill in your blanks. Equity and the liability components. Okay, so we can look at correct cost, correct cost SA. Okay, now we just call it K company. Tongue twister. They issue 1,000 convertible bonds. These convertible bonds is the term convertible bonds is the so-called the key to tell you that, oh, this must be a compound instrument. Okay, convertible. And this 1,000 means that you have 1,000, you just imagine pieces of convertible bonds. This is numbers of bonds. Okay, on first day of January, X1 at par. That means if it's $1, they are going to issue at $1 also. The bonds is redeemable in 3 years. So remember, since we know that the convertible bonds has component of liabilities and components of equities, and you also know that if it contains components of liability, it will have a fixed repayment time. So the fixed period is 3 years. And each one of the convertible bond is valued at 2,000. So which means when you issue out these 1,000 numbers of convertible bonds to the bondholders, you are going to be able to receive how much money? 1,000 times by 2,000. So you're going to be able to receive 2 million in terms of money, cash. Okay, but you can't like debit cash and then credit convertible bonds. No, we don't record convertible bonds, but we need to split the convertible bonds into components of liabilities and components of equity. Okay, so this one got 2 components, liability, equity. So they also tell you the bonds pays interest annually in areas at interest rate based on 6%, which means that this is your coupon rate on. So that means it will be written as 6% convertible bonds. Okay, in your books. But it's just that you can't just record one lump sum figure. Okay, you need to split. You need to split into 2. Then each bond can be converted at maturity into 125 $1 shares. So that means they tell you, you want to convert at the end of the 3 years, boleh. You can convert it into ordinary shares. And then this one, basically, they tell you the prevailing market interest rate for the 3-year bonds that have a no right conversion is 9%. So this 9% is actually the effective interest rate. Okay, so this is the effective interest rate. And then you know that for this kind of bonds that are having the convertible feature, you have to use the split accounting to go and distinguish how much is the liabilities value and the balance will be the equity. Okay, so show the presentation of the compound instrument in the financial statement at inception. So of course, between these two, when we want to talk about the present value of the instrument, we have to use the 9% effective interest rate to calculate. This simple one means, how do we say, your formula is 1 over 1 plus with R to the power of N. So this one, for you to get the simple of 0.772, basically the R is 9%, and then the N here is 3 at year number 3. This cumulative means what? 1 over 1 plus R to the power of N. N is 1, N is 2, N is 3. Cumulatively, this will be the figure. 2.531. That means they didn't give you for year by year. They gave you cumulative year 1, year 2, year 3. Okay? So, which means this is basically a summation of 1 over 1.09 power 1 plus, same again, 1.09 power 2. 2 years from now, plus 1 over 1.09 power 3. So present value factor 1 year from now, 2 years from now, 3 years from now, jumble together, you get 2.531. This one is for the year 3 only. So 1 divided by 1.09, 1 year, 2 years, 3 years. So 0.772. This one is only this figure. This figure is this one. Okay, year 3. For the year only, based on 9% effective interest rate. This is cumulative. Year 1 plus year 2 plus year 3. So you jumble 2.531. Okay? So how do we do the split accounting? As mentioned just now, go and calculate how much is the liability component's value. Then you take the proceeds minus the liability component's value. You are going to get the residual. Residual is the equity component. Okay, so we can see here. All in all, we are going to get 2 million in cash. So this 2 million we need to split liability component and the equity component. So the split accounting says you work on how much is the liability components first. Then the residual will be the equity component. So for the liability components, we have to find what is the fair value of the convertible debentures. So present value of the principal to be paid at the end of year 3. So this is your 2 million. And remember just now we used 1 over 1.09 3 years later. 3 years later. Power 3. So we are going to get 0.772. You times by the face value. This is how much of the present value of the principal sum that you're going to be able to get back 3 years from now, which means at the maturity. And during the 3 years time frame, each year you will be paid interest. The interest that you are going to be paid will be based on face value times by the coupon rate. Coupon rate is 6%. So 6% times by 2 million, that will be your interest. But you also have to present value them. 1 year from now, 2 years from now, 3 years from now, you cumulative it. This is the present value factor on a cumulative basis for 3 years. So when you times it, you're going to get the present value of the interest that you are going to get 1 year from now, plus 2 years from now, plus 3 years from now. So total of all these is actually your liability component. So 1847720. So when this is the liability component, the balance will be the equity. So you take the 2 million minus the 1.847, the remainder will be the liability component. Okay, so once you have already established this, what will be your journal entry? You will debit, because you're going to receive cash, debit bank or debit cash. Then you can split already now, right? Credit your 6%. What is it? Is it a bond? Okay, 6% bonds. And then you're going to credit equity. So 2 million. 6% bond will be the liability component. 1847720. Equity component will be the balance. 152,280. Okay, so that will be your journal entry at the inception to record the convertible bonds. Can I? Any questions on this? Okay so far? No issues, Okay. If no issues, just say no issues, Okay, now we go to the next one that you can do an exercise on. We have this rimba berhad, I believe that I have given to you. So by way of email, so you can go and do the exercise on the rimba berhad. Give you 15 minutes to do. Let me see the question. Rimba. This is the question on rimba. So you follow through the same way, or but over here what I did was that we just split the interest into 3 years. 1 year from now, 2 years from now, 3 years from now. It's the same way as what just now the Karai course example is doing. Okay, so we do another approach, year by year one. So you try to go through this one and then finish it in 15 minutes. So once you finish, you can just crop it and then put at the meeting chat. Okay? So give you time to look at it. 15 minutes. So 10. Okay? And then once you finish already, probably you can just take a toilet break. Can I? You must try to finish it within the stipulated time frame. Okay, 15 minutes. So discuss at 10:10. Every time there is any exercise, you try to complete it within the time. Don't do slow because it will become a habit. And remember that you don't have, you are always rushing for time in the so-called examination. Okay, so I will leave you to go and have a try at this particular question and then come back later. All right, so now we have someone, Dongmun. Okay, so we just have a look at this one. Right. So before we look at the answers, of course, we need to look at the question. Maybe what I can do is I just put it at the question. I've erased already. Okay, so now we can look at this based on your friend's answers. So what do we have over here? The question has informed us that, we have a convertible bond. Okay, so once you know that there is a convertible bond, you're supposed to actually utilize your split accounting to do the splitting between the components of the liability and the components of equity. So this 4,000 is the numbers of convertible bonds. Each bond is worth 1,000. So therefore, you have 4 million proceeds from the issuance of this particular convertible bond. And then, of course, this one just tells you that if you were to convert at the end of the maturity, and how long is the maturity? 3 years, then you can convert into so many numbers of ordinary shares. And then interest is payable annually in arrears at the nominal annual interest rate of 5%. So which means 5% times by your 4 million, that will be the interest that you are going to be able to receive for 3 years. Okay, 3 years. So in other words, this particular interest that you are going to be able to receive for 3 years' time, you are supposed to present value them. So 5% times by 4 million, you are going to get 200,000. So each year, 200,000 first year, second year, third year. Then of course, you are going to present value it using the effective interest rate at 7%. So 1 over 1.07 to the power 1, power 2, power 3. This will be your present value of the interest for 3 years. And then, of course, at the end of the third year, you're supposed to repay back the principal sum. The principal sum is 4 million. So how to get to this particular figure? Basically is 4 million you times by 1 over 1.07 to the power of 3. Okay, then you're going to get this present value of the principal sum payable at the end of the third year. That means when it matures. Here plus all these, you are going to get the liability component. Take the proceeds minus the liability component, the residual will be the equity component. Okay, so I'm sure that some of you have already finished, but it's just a little bit shy to so-called put it up at the meeting chat. So you just check your answers. 209,945. And then of course, we get this very often. A lot of students ask, how many decimal point we must use? So like what Dong Moon has done, 2 decimal points, I think is good enough already. Okay, no need to put like 5 decimal points and stuff like that because it makes no difference one. So even if you round it up to 0 decimal point, it's also okay. So 209,945 or 209,945.27, almost there. Okay, thank you for sharing this answer, Dongwon. Okay, so now we can look at other parts of this question already, yeah? So we have just completed this. So like I say, you probably need to do some rounding. All right, like here, I just round to 0 decimal point. So once you get this already, suppose you need to pass in the journal entry at the inception when the bond was issued, which is at the beginning of X2. So you will debit your bank or your cash, 4 million, and then you credit your 5% convertible bonds with 3970055, and then you're supposed to credit your equity component with the residual. Okay, so this will be your journal entry at the inception. So let's say it's on the first day of January. All these figures you just copy from the schedule just now. All right, this is the liability components figures. Liability component, the residual will be the equity. All right. Then we can go and prepare this particular schedule. This is what we call the amortization schedule. This particular amortization schedule, later on, you will find that quite a number of the illustrations will make use of this. So this is a good example to recall back how to prepare the amortization table. So for you to start off with amortization table, you have few columns. So usually I will call this column 1, column 2, column 3, column 4. This particular figure is the initial financial liability component. You have gotten this from your split accounting. 3790055. So you just go back. It's this figure. And where do you get that figure? It's from here. Okay, the liability component in the compound instrument. Extract that particular figure, put it on the first column of your amortization table. Okay, second column is the interest rate based on the effective interest rate. And in this case, it was 7%. So which means this figure, 3790055 times by 7%, you're going to get the column 2's first figure. Okay, column 3 is basically the coupon rate times by the face value of the bond. So face value of the bond is 4 million. Coupon rate given to you by the question is 5%. So this times this, 200,000 until the day it matures, which is it is going to mature in 3 years' time. Okay, because they tell you maturity date is 3 years. So once you get the column 1 figure, column 2, column 3's figure, how to get to the last column? It will be 1 plus 2 minus 3, you're going to get the last column figure, this one. Okay, so closing of the end of the first year is the same as beginning of the next year. So again, you take this times by your 7%, and then you get to the second column's figure. So 1 plus 2 minus 3, you get to the last column. Okay, you got that? So what is important for you to take note is that by the end of the third year, which is on 31st December X4, the liability figure as shown in this particular amortization table must equal to the face value. Face value. Okay, so that when you actually convert or when you actually pay back the principal sum, you just offset nicely. Okay, so let me just crop this particular one to go to the next slide. Because once you have already gotten this, then the rest will be simple. How to put in all those journal entries? Okay, so this was all the amortization table that we have provided. Okay, so you can see over here. Just now we started off with the liability component, and then we do like, take the effective interest rate at 7%, and then knock off with the interest that was paid based on the coupon rate. Then we get the liability to go to the SOIP at the end of each respective years. So at the end of each year, which is 31st December X2, you need to pass in the journal entry because we have already passed in for the inception on the first day of January X4. Okay. This one we have already done. Okay. So now we need to pass in for the end of first year, end of second year. So you will see that 31st December X2, this is end of first year. All right, where do we get the interest expense figures from? You debit the interest expense is from the column number 2. Then you credit the cash is from column number 3. And then once you have paid this, which means that the balancing figure will go to the convertible bonds, the 5% convertible bonds. So this particular 65,304 is a balancing. Okay, so that one is just the balancing. This is from column number 2. This is from column number 3. Okay, same goes from column number 3, from column number 2. Balancing. Column number 2, column number 3, balanced. Okay, you got that. So which means that once you already obtain the the value of the liability component, then you can start to fill in the amortization table. After you have filled in the amortization table, the next will be to pass the journal entries applicable at the end of each year. Okay, so this is just to capture the interest component and then to make sure that at the end of the day, your liability, when it matures, will be shown at the face value of the convertible bonds, right? And we go to the next one. which means that over here is still the same. We can just paste it again. So where the figures come from, also from the amortization table. So this is the extract to go to the SOPL. Extract to go to the SOPL will come from column number 2. Okay. Will come from column number 2. So interest expense that goes to the SOPL, that goes to the SOPL for the respective years. And then the liability, which is the 5% convertible bond, will come from column number 4. Okay, all this. So you will notice that the equity component will remain the same. 209,945. Where do you get this figure from? From your split accounting earlier. Okay? So, which means that the amortization table is something that you need to know how to do, because that will be the one that you are going to refer to extract the figures to go to the other parts. Okay? So that will be on the what do you call that? On the Rimba Berhad. So maybe this one I should save it, and then later I will post it to the files section, files section of your Teams. Okay. Let us go back to the notes. So just now we were at Rimba. So Rimba, not to worry. Later I will just post up the full answers at the files section. So now we can proceed to others. So we can continue on this. So remember, now that we know if you have fulfilled the definition of the financial liability, financial assets, and the equity instruments, of course, you need to get them on the balance sheet. That means in the books, in the financial statements. So the question is, what value should we write for those financial assets, financial liabilities? Okay, so of course, we will always have the initial recognition and the subsequent measurement. So initially, all the financial instruments are to be measured at fair value. So fair value means what? What is the transacted price? Okay, so that means if you buy and sell at this particular price, this will be your fair value. And then sometimes you may incur transaction costs. So the transaction costs that you incur, you also need to do something in the books. Okay, so they tell you if you have transaction costs being incurred, and if this is with respect to financial assets, then you have to add. Okay, you have to add to the fair value at the initial recognition. However, those that you add must be what? Added to the initial fair value for financial assets. But the financial assets cannot be something that you measured at fair value through the profit or loss. So in other words, remember just now I mentioned you have classifications of at amortized cost, at fair value through the OCI. And then you have fair value through profit or loss. Okay, so they tell you, so long that if you have financial assets, and the financial assets are held at amortized cost or held at fair value through the OCI. And if you have transaction costs, the transaction cost will be added to the fair value at the initial recognition. However, if you have the financial assets held at fair value through the profit or loss, you do not add the transaction cost to the fair value. Understand? So this one, you will add. This one, you are going to expense off the transaction cost to the SOPL. This one, transaction cost, expense off. Okay? And then if you have categories of financial liabilities, so same things, if your financial liabilities are not held at fair value through the profit or loss, then you are going to deduct the transaction cost from the fair value at the initial recognition. Okay, so to simplify, you can see this initial measurement. Suppose should be initial recognition rather than initial measurement. So I suppose this should be initial recognition. Subsequent measurement. Okay, so they tell you, you see all initial measurement, whether it's financial asset, captured at amortized cost, fair value through OCI, fair value through the profit or loss, you will find that all are initially measured at fair value. This is also fair value because they say based on transaction price, which means the amount received when issued is also the fair value. So all initial recognition of the financial asset, financial liabilities, you don't care how they are captured at amortized cost, fair value through the OCI, fair value through the profit or loss, all will be initially recognized at fair value. And then should there be any transaction cost, we look at this column and then this column, should there be any transaction cost if it is an asset? If it is an asset category, like in here, asset category, we are going to add the transaction cost to the carrying amount. Okay, fair value through the OCI, also we are going to add. Why we add? Because it is part of financial assets. Okay, for financial assets captured at fair value through the profit or loss, which is usually held for trading, for trading. So should there be any transaction cost, you're going to expense it off to the SOPL. Just charge it out as a normal expense. Okay, then for the subsequent measurement, what you're going to do? At amortized cost, your subsequent measurement is effective interest. So basically, this is based on your amortization table. Just now you have done the table, amortization table. That's the meaning of the effective interest method. Fair value through the OCI, any changes in the fair value will be captured at the OCI component. And then if it's fair value through the profit or loss, any changes in the fair value will be captured through the profit or loss. Okay, so this is quite simple, right? If fair value through the OCI, any changes thereof go to the OCI. This one, any changes thereof goes to the profit or loss. But of course, remember that if you go to the OCI, OCI basically is the unrealized component. Okay, fair value changes that goes to the OCI, it is the unrealized component. But through the profit or loss, it will be a realized component, yeah? And then you can look at the financial liabilities. At amortized cost, of course, initial measurement will still be the same. If you want, you can put also fair value through the OCI. Okay, also at fair value, any changes thereof will go to the OCI component. Okay, effective interest is based on the amortization table. Fair value through the profit or loss, which means that any changes in the fair value, you will take it to the SOPL. And then similarly, transaction costs, you also have to deal with it separately. For liability components, financial liability components, you will have to deduct the transaction cost from the fair value at the initial recognition. Subsequently, effective interest method or the use of the amortization table. So this one also minus should be from minus from carrying amount. Okay, so for fair value through the profit or loss, if you measure your financial liabilities at that, so which means that any transaction thereof, transaction cost, you expense off, which means that you charge to the SOPL. Okay, so easy to remember. If assets, you plus the transaction cost unless it is measured at fair value through the profit or loss. If it's financial liabilities, you have to minus the transaction cost from the fair value unless the financial liabilities is captured at fair value through the profit or loss. Okay? Then how do we know? We can measure the financial asset at amortized cost, at fair value through the OCI, or fair value through the profit or loss. Okay, so this is with respect to financial assets. So we will say what? Amortized cost, you must fulfill two characteristics. One is the business model test. Business model that says what? You are going to hold to maturity. Hold to maturity. Second one, SPPI characteristics. SPPI means what? Solely payments of principal and interest. Okay, so let me just explain about the amortized cost. So of course, we already know if you have financial assets, we have three different measurements. One is at amortized cost. The second one, which is the same as this, one is optional, one is required. And then the third one is fair value through the profit or loss. So how do we know? We should measure them at amortized cost or fair value. Okay, so for amortized cost, you will find that the characteristics that must be present, must be fulfilled, is that you have to look at the business model, which means that that particular financial asset, are you going to hold it till maturity? So let's say if you have some investment in bonds, okay, which is part of your financial asset, right? Investments in bonds. Let's say your financial asset is investment in bonds. So remember, investment in bonds, even though it says bonds, it doesn't mean it's a liability. Now you buy bonds of another company. So if you have investments in bonds, if you want to measure it at amortized cost, what must you do? You must go and check that they fulfill the two characteristics. One is the business model test. The second one is the cash flow characteristics test. Okay, business model says what? When you buy this or when you invest in this particular financial asset, your plan is to hold it until it matures. So let's say maturity is 3 years time. That means within the 3 years, you're not going to sell off, but you just hold until mature. And during the holding period to maturity, and what you usually will get will be you still collect the interest, correct or not? So the interest or the cash flow characteristics that you are going to have will be solely payments of principal and interest. Let me just type it here. This is solely payments of interest, sorry, SPP, principal and interest. Must have these characteristics. So which means that during the 3 years time frame to maturity, let's say, so every year at the end of year 1, end of year 2, end of year 3, you will be entitled to payments of interest. And when you go to the end of the year 3, they are going to pay you back your principal sum. So that is the SPPI, cash flow characteristics. So if you say yes and yes, that means what? If you say yeah, if you say yes, you fulfill. Yes, you fulfill. Then the financial asset will be measured at amortized cost. Okay, got that? Then you look at the second one, fair value through the OCI. Fair value through OCI. So when you measure it at fair value through the OCI, you look at the characteristics. They tell you business model to hold the debt, both to collect cash flows and to sell the financial assets. So which means that for the financial assets to be measured at fair value through the OCI, you must have one, fulfill the business model test. Business model. But this business model is what? Hold to maturity plus sell if the price is good. And then the second one is still the SPPI. Okay, so the thing here is that you have this word and. This one say you are not going to sell. 3 years, you hold until 3 years. Then you collect the principal and whatever interest that accrues in the 3 years time frame. But over here, for fair value through the OCI measurement, they tell you, oh, actually the characteristics of the amortized cost plus selling of the financial asset when the price is good. So that means this is more elaborative law. So they say, we don't mind holding the financial asset to maturity, but let's say at the end of the second year, we find that the price has gone up so much, it's very good. We are going to sell off. Okay, so that is the fair value through the OCI characteristics. And then, of course, fair value through the profit or loss usually is must fulfill the characteristics of held for trading. Held for trading. Okay, got that? Same goes with the financial liabilities. So they will tell you, if you want to if you want to measure it at fair value through the profit or loss, they must be held for trading. Okay, amortized cost will be most of the financial liabilities. So just now you have seen bonds and all those, usually they are at amortized cost because they fulfill the business model test and the cash flow characteristics test. Okay. Then all other bases, this one usually we don't have lah. All right. Then, of course, sometimes we may find that certain financial liabilities are designated as fair value through profit or loss. Designated means that you assign it, and this particular designation must be done at the initial recognition. Okay, so that means initially, when you have this particular financial liabilities, and you find that this particular financial liabilities are held for trading, so you designate it as measured at fair value through the profit or loss. And when you measure it at fair value through the profit or loss, of course, we know any changes in the fair value will go through the profit or loss, right? But over here, you must distinguish the gain or loss in the period resulting from credit risk, like just now what we have seen much earlier. I said that later financial assets, financial liabilities will be subjected to ECL, expected credit losses. So that means you differentiate the changes in the fair value because of credit risk and because of other issues. Okay, so when you present the time, you just need to split the two lah. Okay, classify into gains or losses resulting from credit risk or other gains or losses due to other factors. This one is your IFRS 13, which is a fair value measurement. You have level 1, level 2, level 3, which I think Ms. Lim has already gone through. So this one, we are not going to look very much about it. But of course, if you have gone through IFRS 13, certain things that you must understand and know by heart from the standard. Number one, what's the definition of fair value? And then principal market, most advantageous market. And what's the so-called accounting and accounting treatment with respect to transaction costs, with respect to transportation costs. So that's about all with respect to IFRS 13. Okay. So now we have few scenarios that talks about how to measure, how you're supposed to treat the transaction costs, etc., etc. Okay, this is a Palermo question. So Palermo question has few so-called parts. So you have A, B, C, D. Okay, and then what's the requirement? Explain how the above transaction should be accounted for in the financial statements for the year ended 31st December 20X6. So this is the year end. Okay, so before we look into this, maybe you can just take a 10 minutes break before we proceed. So if you are back early, just have a quick look at all this, and then we are going to run through this particular exercise. Okay, 10 minutes break. So come back at about, it's almost at about 11. Then we will continue with Palermo question. Once you have gone through Palermo question, basically you will have a better understanding about financial asset, how to prepare the amortization table, what's the accounting treatment for the transaction costs. Okay, you will also appreciate more with respect to coupon rate, effective interest rate. Okay, and then the different classifications of financial instrument. All right, so we take a break, we come back at 11, then we will continue. So far, any questions or not? No? Okay, so we take a short break. Okay, so we will look at the Palermo illustration now, yeah? So you can see that all those that are highlighted in different colors, so which means that these are the important information, all right? And of course, since we are just looking at the financial instrument kind of classification and then the accounting treatment, so the illustrations here will also be scenarios that you can apply your knowledge up to now lah. Okay, so we will look at this. We have Palermo, public listed company, requested your advice. Of course, you must be somebody lah, before they requested your advice. So you just assume that you are the accountant or the CFO or the CEO. All right. Explain how the transaction should be accounted for in the financial statements for the year ended 31st December 20x6. So this is your year end. Of course, in terms of financial accounting, we must always remember when is the year end one. This one very important. Okay, so they tell you scenario A. Palermo purchased 50,000 par value loan notes. So do not be so-called intimidated by the word loan notes and then straight away say that this is part of the liabilities. But remember, the keyword here is Palermo actually purchased loan notes from the issuer of the loan notes. So which means that Palermo has investments in the loan notes. So if Palermo has investment in the loan notes, which means that that particular investment in loan notes is part of its financial asset. Okay, so like I say, at the inception itself, of the scenario given to you, you must establish whether you are looking at financial asset, financial liabilities, or equity instrument, so that later on you can apply the correct accounting treatment. Okay, so they tell you they purchase the 50,000 par value, which means that the loan notes has a value of 50,000. But when they purchase it that time, a 10% discount was given. So which means when Palermo actually pay for this particular 50,000 face value of the loan notes, they only pay 90%. So because 10% is given to you, 90% of the 50,000. So which means 9 times 5, 45. They only paid 45,000 for an investment in the loan notes that is worth 50,000. Okay? And when was this purchase made? 1st January 20x6. That means at the beginning of this current financial year, intending to hold them to their maturity on 31st December 20x9. So you bought it in 1st Jan x6. So x6 is 1 year, right? x6, x7, x8, x9. That means it's a 4 years kind of maturity date. Okay, and you intend to hold them to maturity. So this is your held to maturity. And then what do we have? We have financial asset that we are going to hold to maturity, and some financial asset that during the particular 4 years time, you are going to receive payments that are solely principal and interest, SPPI characteristics, because they tell you this particular investment in loan notes has an interest coupon rate of 3% and it will be paid annually. That means for the next 4 years, while you hold this particular financial asset to maturity, you're going to be paid 3% of the par value. So that means 3% par value is how much? 50,000. So this will be your annual interest based on the coupon rate times by 3%. So it's going to be 1,500. Annually, you're going to get for the next 4 years. And then the question also informs you that there are some transaction costs. So remember just now, what did we say about transaction costs? This is Palemo. We can go back to the financial instrument. What did we say about transaction costs? Since we are looking at financial asset, and my guess is that the characteristics to measure them at amortized cost will be fulfilled, and now you incur transaction costs. So the transaction cost means that the transactions cost should be added to the carrying amount of the financial asset. Okay, so which means transaction costs we add to the carrying amount of the transaction of the financial asset. And then they tell you the annual internal rate of return on the loan notes is 5.6%. So which means this is your effective interest rate that you need to use to calculate so that you can complete your amortization table. Okay, got that? So which means that this was the initial sum that you pay for this financial asset. And since you have transaction costs of 450 and the accounting treatment says you need to add to the carrying amount. So initial recognition will be this figure plus this 45,000 plus with the 450. That's the initial recognition. And of course, later on, if you want to find out whatever, how much should be the transactions in the books and so on, you just need to prepare your amortization table. Okay, so from this particular exercise or scenario, you already know, oh, if you have financial asset measured at amortized cost, then any transaction cost is to be added to the carrying amount. Then you know that the period to maturity is 4 years, coupon rate 3%, effective interest rate 5.6%. Okay, so now we can proceed. So how to so-called prepare for the solution to this. First thing we must say, how the loan notes or the investment in the loan notes should be measured. So they should be held at amortized cost. Why? You must explain. So the business model test and the cash flow characteristics test are being fulfilled. Okay, so business model says what? You're supposed to hold the item to maturity, HTM, when purchased, and the contractual terms gives rise to cash flow. So that means the cash flow characteristics are such that the Palemo will receive payments that solely payments of principal and interest, the SPPI characteristics being fulfilled, HTM characteristics being fulfilled. So if you say yes and yes to this, that means your financial asset should be measured at amortized cost. Okay, so far up to here. So that means quite obviously you will make use of the characteristics to determine whether you measure it at amortized cost or not. All right. So if you say yes to it, then of course you must explain why is yes. So what do you mean by HTM? What do you mean by SPPI? Okay. Then you're supposed to calculate how much you are going to recognize in the SOPL at the end of the year. Okay, so which means what? Remember your initial recognition should be at how much? 45,000 because you're given the 10% discount on the face value, so you pay 45. But because you incur transaction cost of 450,000, so this 450 only, not 450,000, 450, which means that you should add to the 45,000. So, in other words, once you added them, the 90% of the face value plus the transaction cost, you will have the first figure of the investment in the loan notes. Okay, so it's either you prepare in this particular table form, which is this is the column 1, column 2, column 3, column 4, or you prepare them in a tabular format. So this is column 1, 2, 3, and 4. Okay, so same things. If you put it in this particular table, you will realize that this is like your amortization table like that, right? So therefore, for the compound instrument, more or less, it's a revision on how the amortization table is supposed to be obtained. Okay, rather than so much of the split accounting. But if you don't do split accounting, then you cannot get the first figure to the amortization table. Then you can't complete the amortization table. Okay, so this is your amortization table. First figure, we are going to insert it here. Then, interest income. Why do we say this is interest income? Because this is a financial asset. You have an investment in the loan notes. So Palemo is going to receive the interest income. So interest income will be based on the effective interest rate. So as given by the question, effective interest rate is 5.6%. So once you take 45450 times by 5.6%, you're going to end up having 2545. And then interest that Palemo is going to receive in cash will be the 3% times by the face value. So in that case, just now we have already computed 3% times by the face value of the financial asset, you're going to get 1,500. So we are going to put it here. So as usual, 1 plus 2 minus 3 equals to 4, which is the last column. So you can see, contrast this particular table with this one here. It's the same. It's 1 plus 2 minus 3. You get the closing figure at the end of the year. So that now. So remember just now, we have seen from the Rimba question, column 2 will go to the SOPL. Column 4 will go to the SOFP. Agree or not? Let's have a quick look. So if the extract to go to the SOPL comes from column number 2, that means from here. From here. So, in other words, 2545 will be reflected as interest income. Okay, because your investment in the loan notes. Okay, so this is interest income to Pamelo. So, interest income will go to the SOPL. And then at the end of the year, originally you have paid so much reflected in the books. At the end of the year, you will champo with the interest based on the effective interest rate minus the interest component that has been received. So 1 plus 2 minus 3, you're going to get this last figure. This figure will go to the SOFP. Okay, so this means that the first illustration, part A, already completed. Understand? Can I? We move on. Second one. Palermo purchased some shares in an unquoted company. So what's the meaning of unquoted company? Unquoted company means that the shares of the company that are not listed. Okay, the company is not listed in the bursa, let's say in the context of Malaysia. So that means it could be a Sendirian Berhad, it could be just a partnership or something like that. But it's not listed company, as an investment for 12,000. You see, when you purchase some shares in an unquoted company for 12,000, there is no way for you to verify whether the 12,000 is the fair value or not. Correct or not? Because since it's not a listed company, then you don't know what is their fair value. Okay? And remember, when you purchase some shares of another company, this is actually what? When you buy shares of another company, this is investment in equity shares. Okay? Investment in equity shares. So which means this is also part of your financial asset. So what happens? Palermo purchased some shares in an unquoted company for 12,000. At the year end, the director stated that the shares might be worth. So that means there is no way to find out. It's just agak-agak, oh, I think it should be, the value should have gone up lah, maybe gone up by 1,000. So they say, oh, maybe it's about 13,000. But a formal valuation was unable to be performed because of lack of data. Of course, cannot verify lah, because the shares of these unquoted companies will not be bought and sold in the open market, right? Maybe it has not been sold out before. So there is no data to be collected. So the question is, how should you account for the financial instrument in the books? Okay, so your investment in equity shares, of course, first we say all financial instruments must be initially recognized at fair value. So now we don't know whether the fair value is 13, 12, or some other figures. But what we know is that Palermo bought those shares, bought those investment in the equity shares for 12,000. This is already done deal, so you know that this actually took place. But how much is the fair value of the shares? You don't know, can't tell, because probably never transacted before since they are unquoted. So, but we know that all financial instruments needs to be measured initially at fair value. All right, so how we go about doing this? So they tell you, this is an investment in an unquoted shares of another company. So which means that you should initially recognize them at fair value. But however, we can't get the fair value, right? Because it is not openly traded. The fair value cannot be measured. So they tell you, in this particular limited circumstances, that means, not often that is going to happen, but of course, it did take place for this particular scenario. And because of that, and because the company is an unquoted company, fair value cannot be measured. Okay? And if the fair value cannot be measured, like in this instance, because it is an unquoted company, so they tell you, you can, all right, take the cost as the appropriate estimate of the fair value. So you just say, oh, okay, so now you cannot find because the shares are not openly traded in a stock exchange because it is an unquoted company. So, or the best that we could do is just use the cost as the appropriate estimate for the fair value in this case. And of course, this is actually a scenario that was supported by the Para B 5.5 of IFRS 9. So, which means if they tell you, oh, cannot get the fair value, now you just use the cost as the proxy for the fair value. So, in other words, the shares will remain at 12,000 as an investment in the unquoted shares of another company. Got it? So you look at the next one. Palemo took out a speculative forward contract to buy coffee beans for delivery on 30th April X7 at an agreed price of 6,000, intending to settle net in cash. Due to the surge of unexpected supply, the forward contract for delivery on 30th April would have cost 5,000 on 31st December X6. So 31st December X6 is our financial year end. So have a look at this. What does it mean? What is a forward contract? Just now we have seen also earlier of the day, what is the meaning of forward contract? So forward contract means that you enter into a contract now to buy something in the future and you are going to settle net in cash. Okay, so forward contract, let me just put it down. Forward contract are actually what? Agreement to buy and sell. Buy, not and you buy or you sell, not and. Buy or sell an asset at a fixed price at a fixed future date. So, which means what? You enter into a forward contract to buy coffee beans. Okay, so they enter into a forward contract to buy coffee beans. And then these coffee beans will be delivered to them on 30th April X7. And how much did they pay? 6,000. And they are going to settle net in cash. And earlier also, we just mentioned that forward contracts, what happened? We also know that forward contracts are examples of derivative contracts. Derivative contracts. So derivative contracts, one of the characteristics is low or no initial outlay. Initial outflow. So no need to pay at the initial. Next characteristics is, what is the next? we actually say that you have to settle net in cash. In cash. Okay, so from here we know that when you enter into a speculative contract, a speculative forward contract, you are going to agree to buy what? Coffee beans, which is an asset to you, at a fixed price. How much is the price? 6,000 at a fixed future date. That is 30th April X7. That means you buy something and the price is determined today for something that is going to be settled net at some time in the future. That means this is actually quite speculative, is it not? So today, based on today's condition, you thought that maybe I should just enter into some derivative instrument. All right, but without knowing what the future would hold. Understand what I mean not? If you can read into the future, there is no necessity for you to do any preparation or whatsoever, because you already know what is going to happen. But we always just can estimate, can forecast. When the time pass already, then only we know, oh, the forecast and the actual got variance or not. Okay, so in this case, Palemo took out a speculative forward contract to buy what? What item is it that they are speculating? This is coffee beans for delivery on this date. How much? 6,000. Settle net in cash. Settle net in cash, meaning that if the whole transaction, when it reaches the so-called delivery date or the maturity date, and then you find that you are in a favorable condition, which means that you make a gain, then some money will enter your bank account. But if you are at the net loss situation, money will flow out from your bank account to pay. Understand? So, but they are not going to take possession of the coffee beans. They only settle net in cash. So, due to surge in expected supply. So, meaning what? Expected supply surge. Surge in expected supply. So, you know that coffee beans is an agricultural produce. Maybe when you enter into the contract that time, you didn't know that the weather condition is very favorable for the coffee beans harvest. So sometime on 31st December X6, which is the end of the financial year, they tell you that, oh, okay, since we enter into the speculative forward contract already at this year end, we find that, wow, bumper harvest for the coffee beans. So bumper harvest means that the weather condition is very good. The plantations are able to harvest most of the coffee beans that they have planted. No wastages. So, which means increase in supply. All right. So when supply increases, what is going to happen to the price of the coffee beans? The price will drop. Okay, so when the price drop, if you were to enter into a forward contract on 31st December X6, you only need to pay 5,000. Okay, so which means that if you enter into those forward contracts, since the word is speculative, it doesn't mean that you will always make a gain. If you don't do your homework well, or maybe there are some adverse conditions that are beyond your control, you may end up having a loss. Okay, so speculative kind of nature is like this. High risk, high returns, ma. Okay, so in this case, it would be better off if you don't enter into the forward contract earlier. Then if you want to, you can enter it on 31st December and you only need to pay 5,000 for it. But the thing here is that we don't know at that time. Understand what I mean now? So if you don't know at the time, maybe you think that, yeah, I think it's a good decision. Then come year end, oh gosh, I shouldn't have entered into the speculative contract because now the forward contract is only worth 5,000. So I've already made a loss of 1,000. Okay, so how do I account for this in the financial statements? So this is a forward contract. A forward contract not held for delivery of the entity's physical expected purchase and not held for hedging purpose is to be accounted for at fair value through the profit or loss. Because a forward contract usually do not take possession of the coffee beans. Okay, so even though we are engaged in a forward contract to buy coffee beans, but we just settle net in cash. We do not take possession of the coffee beans. Possession. Okay, so we just want to settle net in cash. We don't take the coffee beans. Coffee beans. We just take the profits, the gains, or we have to pay out from our own pocket for the losses, right? So what happens? They tell you, and not for hedging purposes, all right, is to be accounted for at fair value through the profit or loss, because this one is held for trading. Then the value of the forward contract at the inception is 0. Because remember, since forward contract is part of the derivative contracts, and derivative contracts can be entered into without any initial outflow. So no need to pay anything. Just sign a contract to enter into some forward contract will do. All right. Inception is 0. Okay. But of course, you need to put a disclosure in line with IFRS 7. And then they tell you value of the contract at year end, because the question wants you to record, right? What will be the accounting for the forward contract at year end? So market price for the forward contract at year end. Year end is 31st December X6. For delivery on 30th April X7 is 5,000. This one we know. Year end, the amount, if you enter into the same transaction, but it's just that you enter into the forward contract a little bit later, you only need to pay 5,000. But Palermo's forward contract price that they pay is 6,000. They have already paid this. So in other words, the difference is actually a loss. Okay, so this loss will be charged to the SOPL, and at the same time, you are going to recognize a financial liability of 1,000. Okay, we go to the next one. I think this is the last one. Yeah. So we look at this. Now that we are going to look at no more purchases, now we look at the sales pula. So you're going to sell off your shares. In July 20X6, Palermo sold 12,000 shares for 16,800 at their market price on that day. So they sold off their shares. It has purchased the shares through a broker in 20X5 for 125 per share. So, which means last time they pay for is how much? 12,000 times by 125 per share times by 1.25 per share So this will amount to how much? 1.25 times by 12,000 numbers of shares. So they paid 15,000 for this. Okay. So they sold. It has purchased the shares through broker. That means they are selling off some of their investment in equity instrument. Then the quoted price at 20x5 year end was 132 to 134 per share. So what happens for this? When you sell it off at 125 per share, sorry, when you bought it at 125 per share, of course at the year end, you also need to go and find out how much is the quoted price. And of course, we are going to take the lower boundary, of course, because we are very conservative. Okay, so they tell you, you bought the time is 125. You sell off the time in the year 20x5. Last year, it was 132. Okay, so we think that, oh, actually it has gone up already lah. The broker charges transaction cost of 1% on purchase or on sales price. So this means what? When you buy the shares, you will be charged 1% as brokerage. When you sell, you also have to pay 1%. All right, it's just like, if you have bought shares in the open market before, you also need to have, normally they say the brokerage fees, certain percentage of the transaction price. Okay, and then what happens over here? Palemo makes an irrevocable election. That means once you have elected, you cannot change. That's the meaning of irrevocable. For the changes in fair value of investments in equity instrument not held for trading to be presented in the OCI where possible. So that means even though the shares are actually traded, but they tell you for this particular investment, Palemo say, I'm going to make this election so that I measure them at fair value through the OCI. Okay, irrevocable means what? Once you already determine you are going to measure at fair value through the OCI, you can't change anymore. Okay, you can't change anymore. That's the meaning. So how do we account for this? So we can go to the next slide. So since the irrevocable election has been made, so the shares will be held at fair value through the OCI. Of course, if they are not, if Palemo did not make an irrevocable election, what will happen? The shares will likely be measured at fair value through the profit or loss. Okay, but since an irrevocable election is made, so they will follow lah. Shares were held at fair value through the OCI because Palemo say this is what I want. Okay, then the originally recorded cost will be 15150 in 20x5. How do we get 15150? Because remember, you purchase that time, the 12,000 shares, you purchase them at $1.25, but you have to incur brokerage. Brokerage is at 1%. So 15,000 you spent, but you still need to add on with the transaction price of 100 and 1,000, no, 150. 15,000 times by 1%. So 150 plus with 15,000. So it will become 1515. Okay, that's the amount that you have spent to purchase the 12,000 numbers of shares. And then at year end, which is 31st December X6, they tell you that the value of the quoted shares is at 1.32 per share. So you're going to take this and then times by the 12,000 numbers of shares. So which means the value of the shares is 15840. So you take the difference between the two, the difference actually is a gain. And because they measure it at fair value through the OCI, so the gain will be reflected in the OCI. Okay, got that? Then what happens? Because that one is at year end only, at year end. Then what happens when it matures? I mean, when you actually sold it off on July 20 X6. So when you sold off, you have to de-recognize. So how do you do the de-recognition? Before you de-recognize, you have to remeasure them to the fair value first. Then only can de-recognize. Okay? So just now, what we have seen is 15150. This is at year end. Year end, you remeasure. Then you get some amounts of gains. And since you have not sold, this particular 690, even though it's a gain, it is still unrealized. Okay? Unrealized, huh? So it's here, here, and here. 15840. This is our status, huh? If I copy balik. Then what happens? Just before you de-recognize, you must measure them to their fair values first. Okay? So when you remeasure them at their respective fair values, it was how much? It was sold for 16,800. Okay? So which means you know that they were sold at 16,800. So between these two, you make another gain of 960. Okay? So you debit your financial assets with the difference of 960, which is from here. It's my highlighter. This particular figure, 900, oh, can't see, 960. Okay, you can see, 960. Where is my eraser? I don't know where. Okay, 960 here, 960. So this 960, you pass again another journal entry because this is also a gain. Okay. Then financial asset, the difference 960, because just now the first gain, that is at year end. The second gain you are going to put in just before you really de-recognize it from the books. So, i.e. sales price as they are sold at the open market, and this gain is reported to OCI. Okay, because the classification is at fair value through the OCI, so these items will not be reclassified to the profit or loss. Okay, but if you have them at fair value through the what do you call that, profit or loss, then you will do the reclassification. But over here, no. All right, so to the OCI, second time. And then this last journal entry is for the derecognition portion. So on derecognition, what do you do? Because remember, when you sell off your shares of another company, your brokerage charges is also 1%. So you sold off for 16,800, but the money that you receive, you must knock off the brokerage. 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 Brokerage charges. Brokerage charges. Okay, this is 1% of 16,800. So in other words, 1% of 16,800 will become 168. So the net that you are going to receive is cash is after the brokerage charges, which is 16632. Okay, so if you look at this, okay, so you will find that at the end of the day, the financial asset will be derecognized from your books because you have already sold them. Remember, one of the criteria for derecognition is when the asset has been sold. Okay? Then the transaction cost, which is the brokerage charges, will be charged to the SOPL. And this one, remember, it is fair value through OCI. So that's why any changes in the fair value gains, in this case, everything will charge to the OCI component. Okay. Any questions for this one? So which means that if you summarize it, these are the movements. Can? Let me go back to this one. Initial recognition, this one we have already done it. Alemo, we have finished. Okay, so now before we break for lunch, I have one short quiz that I want you to look at. Let me just go and get the link for you shortly. Just give me a minute. This is a very simple quiz of 4 or 5 questions only. So I think I will only give you about 10 minutes. I think 8 minutes also can. Okay, short quiz on financial instrument. This is basically all those that we have discussed since morning. All right, so you can see the short quiz, the link. Okay. So you try this out in about 10 minutes. I think less than that also you will have finished. Okay, so Once everyone has submitted, then you can go for your lunch break. Let me see how many people have submitted. Okay. Okay, you can look at this, give you about 8 minutes to complete the quiz. You can start now, yeah? Okay, shortly we will look at it. Another few more to submit. How many students we have in this class? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we have 10 students. So far, how many have submitted? 8. So 2 more. One more. So all have submitted, okay. But maybe you can just sit on it for a while. Go for your lunch break. After that, then only we just quickly run through because I think the score is still quite okay. Average score was quite good. Okay. Still on 3 point something. That means more or less everyone got most of the questions correct. Okay, so we break for lunch. Then after that, only we just have a look at it. Maybe there are some of the students who will want to attempt it. Okay, so come back at 1 o'clock. Okay, you may go off now for your lunch. See you later.